When choosing a reliable airline to fly with, most people would look at the past on-time performance of airlines. The same applies to choosing a participating policy of an insurance company, as many would refer to the past average fulfillment ratios of insurance companies before making their choice. This ratio indicates whether non-guaranteed benefits have met expectations. For the ease of comparison, some information websites use the average fulfillment ratios of all products under the same insurance company to represent its overall performance. However, this number may not reflect the insurance company's actual performance. Before looking at the misconceptions around the average fulfillment ratio, let's look at the two ways of calculation. The first method is simple average. This method disregards the actual proportions represented by different plans. Instead, it treats all plans as having equal weights, regardless of the respective numbers of policies, issued by simply averaging out all values. The second method is weighted average. This method takes a proportional or weighted approach. Better-selling plans will therefore have a relatively larger influence on the outcome. Let's see if these two methods can truly reflect the performance of an insurance company. Let's assume that an insurance company has two participating policies, Plan A and Plan B. Using simple average, the average fulfillment ratio can be as high as 100%. However, Plan A, held by most customers, has a fulfillment ratio of only 70%. As we can see, simple average is often not an accurate description of what most policyholders are gaining and how the insurance company is performing. Then what are the disadvantages of weighted average? Let's have a look at another example to better understand. Assume that insurance company A offers three participating plans, A, B, and C. The sales results are multiplied by the fulfillment ratio, and the sum calculates the weighted average fulfillment ratio of 105%, whereas insurance company B also uses the weighted average method to calculate the average fulfillment ratio of its plans D, E, and F, which is also 105%. However, Company A's plan did not perform as well as Company B's plan, with Plan C being much lower than 100%. And yet all of Company B's plans have a fulfillment ratio of 100% or more. If we only take the average fulfillment ratio into account, we will overlook the significant difference between the performance of the two companies. This shows that neither the simple average nor the weighted average may reflect the overall performance of the insurance companies. In fact, fulfillment ratios are influenced by many factors, including plan type, policy issue period, policy currency, claim history, etc. As you can see, when choosing a participating insurance plan, it is important to weigh up all aspects of a company's performance against your personal needs and risk profile, much like you would when choosing an airline to fly with. You can compare the actual performance of different insurance policies by visiting the insurance company's official websites before choosing one that suits you. For the fulfillment ratios of different HSBC Life insurance plans, please visit this website.